We're going to be talking about two things today. Number one, Halifax HPI, which is showing that house prices continue to come down despite the property bulls and despite the rhetoric that goes in their house price index about resilience. We are seeing more falls. And the other thing I want to talk about is Metro Bank and what's going on in the banking system. And is that a cause for concern going forward for the next 3-6 months with the property market? How are those two linked? First of all, a very good morning to everybody. I know I usually go live in the evening, but it's Friday. We do have things to do in the evenings on Fridays. If you can see me and hear me, please give me a thumbs up and please type something in to the comments as we are live. Please put your questions in as we go along. If you're watching on the replay, again, please put your questions or your comments in as I ask them as if we're on the live, and I'll always come back and answer them for you. For those of you who are new, and welcome to all the new subscribers from the last week or so on these live streams, my aim is to cut through the headlines, cut through the BS, look at what's actually going on with the data to enable everybody to make better decisions with their money and their investments, specifically in the property space, but also in wider business space as well. So that's what we're going to be covering today. Let's crack on without further ado and see what we have in the figures. Now, I don't know if you've managed to have a look at the HPI that was released this morning. The headlines are, we have another month change of 0.4% down. Now, this is actually, for me, more than I was expecting, because if you remember last or beginning of this week, we talked about Nationwide, which was reporting a level month for September. When we looked at the actual figures, the little porcupines that Nationwide were telling is that on a non-seasonally adjusted basis, on a nominal basis, house prices actually came down, but they reported a 0% rise or fall, so level for Nationwide. But Halifax have reported a 0.4% monthly change drop. We're on a minus 1.8% quarterly change, which is starting to add up. And the annual change has also increased in terms of negativity from minus 4.5% in the last report to minus 4.7% in this. So we are seeing continuation of the house price drop. Okay, so let's dive into this in terms of what it's actually saying. It's making quite a big deal here, okay, about minus 4% in September compared to minus 1.8% in August. Now, for those of you who watch regularly, you remember when August came out, I was actually pretty surprised to see that minus 1.8% figure. They're kind of saying, and we'll go into the rhetoric in a minute and have a look at how they have. Well, in fact, let's just go into the rhetoric now. Let's look at this headline they put in. UK house prices fell again in September, but pace of monthly decline slows. Yes, fantastic. We had a massive drop in August. We had a less of a drop this month. So the headline is pace of decline slows. No, I actually fundamentally disagree with this. And as we go through this data, I'm going to show you actually the pace of decline is increasing when we zoom out and look at a half-on-half or a year-on-year basis, right? The pace of decline is actually accelerating. So I think that's a materially misleading statement or comment, which is the very first line in the HPI. So, when you read that, if you don't know anything else that's going on, you might well go, okay, look, we're starting to bottom out. No, let's just look at the trends, and we will do in a second. Minus 4.7 to minus 4.5, they make a big deal that we're pretty much unchanged. No, the year on year has dropped more. They're still hanging on to this this rhetoric that we're still way above the pre-pandemic levels. Look, the pre-pandemic levels of property are like 4 years ago now. That we had huge growth, huge quantitative easing, huge house price inflation over that period. I don't know why we're still relating what's going on now to something that a level that was started 4 years ago, and we saw a massive surge with a completely different set of economic circumstances. And the rhetoric still seems to be that because we're above where we were pre-COVID, that everything's brilliant. No, we've gone up, we're coming down. Every time we go down on a month-on-month basis, more people are falling into negative equity, which actually causes more of an issue in terms of the wider acceleration of issues, especially when affordability starts becoming an issue. And we'll talk about that later as well. Funny old thing, sorry, I've got a moth in here, that's bizarre. Funny old thing, south of England still sees the most downward pressure on property prices. That's to be expected and reflects very much what we saw on the Nationwide. So let's look at the graphs on this. We can see that the dark blue line here, if I just zoom in on this, the dark blue line is the year on year. So if we look at the trends, we're pretty much seeing a direct trend coming down. Interestingly, the purple Okay, this purple line is the month-on-month change. And when you look at it here, if we just zoom in on this, by the way, I'm so glad to be back on the iPad. We got the iPad back. It looks like it's come up, right? These graphs can be so misleading because this is a bit of a visual illusion. When you look at this graph, it looks like we've had a month-on-month tick up. To the uninitiated, you probably go, oh, look, we're going back up slightly, or everything's cool. We've reversed the trend. We haven't reversed trend. And those of you who watch regularly will know I talk about that the most important thing for us to look at here are the overall trends. We need to really put trend lines in on everything to assess direction rather than month-on-month variations. Okay, so I think that's a misleading month. If we actually rechart this and put a sort of red line, horizontal red line onto that chart of where we are on this month, you can see that red line. If you go towards the axis on the left-hand side, it's still negative, right? So we're negative minus 0.4. The reason we've got that tick up is because August was such a large drop of minus 1.8 or wherever it was. So here we're negative 0.4. And if you look at that negative 0.4, we're still pretty much, a bigger drop month on month than all of this period here. All of those months are sitting above the red line. All of those months are certainly sitting above the red line, and that was our little spring bounce that we had. We've only really got 3 months in the last 12 that have been bigger drop than this month. We've got that one, we've got that one, and we've got that one. This is following post mini budget. So when I look at that, when we get rid of the the visual illusions, it's still a pretty significant drop, I would suggest. What does that do to house prices as the overall? So remember, this is month on month, quarter on quarter, year on year percentage changes. This is the graph of actual house prices. And again, let's just trend it. Let's just chart it. Okay, we have a very definite trend, coming down here. So anybody who still says that we're not in a declining property market, I think we have to be realistic here. Okay, we definitely are on a trend basis. Yes, it's not in a straight line. We had our big mini budget spike down. We then had our spring bounce, and last month I was talking about potential double top in terms of that. Now, when you look at the ONS data, if you remember last month's ONS data, it's actually showing a slightly higher bounce than the Halifax. Now, the Halifax and the ONS are probably the two most closely correlated. When you look at both of them, their models, their hedonic regression models, are pretty similar in terms of how they calculate it. But the ONS, don't forget, includes cash purchases. So probably includes different sort of metrics or methodologies for new build. Something in that ONS data is talking about quite a skew in the new builds. And I'm not sure if that filters through quite the same into the model that Halifax uses, which is why I think on the ONS data, we've seen what it looks like more of a double top. Whereas on the Halifax, we've definitely come down more, and now we're definitely trending down. So let's maintain the watch of this trend as we go forward. Let's look at some of the language that's used. Kim Kinnard, director from Halifax, is saying, there you go, minus 4.7%, largely unchanged from minus 4.5% in August. No, it's further down on a year-on-year basis. What I haven't actually got the data is what the month-on-month was, the year that's just dropped out. So when we're calculating year-on-year, we have to be aware of what the preceding year's data is, just like when we go through the CPI data. That's really important to understand because we could still be having massive drops, but if the year before had a big skew or a big spike or drop, that's going to skew that year-on-year data. So we have to see it in the context of that. Again, look, they're saying still remain £40,000 higher than March 2020. Guys, we are in massive inflationary environment, and we have been for 2 years now. Okay, we are in what's inflation in the last print? 6.8, 6.9%. So we're seeing if you see year on year, minus 4.7% drop in nominal house prices, but inflation is year on year 6.8, 6.9% up, right? That's a big gap in real house prices. That's important to understand. Again, rhetoric, house price resilience. They still say resilience, right? If you look at this, does that look like we've got a lot of resilience going on? No. This is property. Property takes ages. It's glacial pace. It doesn't just suddenly capitulate like stocks and shares. So we can keep holding on to this resilience if we want, but for completely forgetting those macroeconomic factors of real house prices versus nominal house prices and the rate of change of things. It does say, more resilient than expected over the period despite higher mortgage rates. It's still filtering in, right? The mortgage rates we've seen over the last 12 months, we're still not feeling the effect. You've still got 110,000 people every single month coming off cheap fixed rate debt of 2% or less. Every month, that gap, I call it the gap of the amount people are paying versus the amount, fixed in, is widening. So it's still filtering in, and will do over the next 12 months. They do mention this as almost as if to caveat. However, as we've highlighted previously, there's often a lag effect between rate increases and the full impact of higher mortgage costs on house prices. They're saying there's more to come. And when we look at this last bit of the HPI, it says, however, with base rate now likely to be at or around its peak, right, we are seeing fixed rate mortgage deals ease back from recent highs. Wage growth also remains strong, which has helped affordability. Yes, this is true. This is the important thing, and I highlighted this, and both HPIs, both indices are now saying this quite categorically. Many economists and financial markets predict that base rate will remain higher for longer, with any significant cuts appearing unlikely until inflation gets closer to the Bank of England's 2% target. Now, that 2% target is unlikely probably to be felt next year into 2024. So again, we're starting to predict, or the analysts, the indices starting to predict this higher interest rate environment, even if the headline mortgage rates for the lenders right now are coming down, because yes, the swap rates have come down and nobody's borrowing, so the lenders are still fighting for business. So yes, the headline rates of 2-year, 5-year fixed rate mortgages are coming down. Swap rates have come down. But let's look at the long-term persistent level that this sits at. I keep talking about it. The peak figure is irrelevant. How long they stay high is relevant. And everybody's now saying interest rates are going to be higher for longer than everybody expects. Okay, so overall, these factors are likely to keep mortgage rates elevated in comparison to recent years, constraining buyer demand and putting downward pressure on house prices into next year. Okay, so even Halifax is now saying into next year, into 2024, we're going to still see house price drops. What's your thoughts? I put last time we went live, I asked a question: where do you think the base rate? So let's not talk about mortgage rates. Let's talk about Bank of England base rate. Where do we think it's going to peak? Number one, do you think it's peaked? Number two, where do you think it's going to peak if you don't think it's peaked? And number three, where do you think, or when do you think we're going to start seeing it come down again? What's your thoughts? Please put that in the comments now. By the way, just before we go on to the next slides, as we're up and running now, I would like to ask you one favor. I always ask this one favor. As you know, my aim with these live streams and the aim of this channel is to cut through the BS that we get from, dare I say it, other fellow property channels, money channels, which is all hype and hyperbole, and also cut through the BS that's in the mainstream, to be able to give you realistic and powerful content that gives you the actual ability to take ownership and control of your futures, whether it's financial, whether it's health, whether it's success, whether it's business. Okay, that's my aim, that's my mission, it's what I want to do. Amazingly, on YouTube, we get even though we've got tens of thousands of views every single month, I only get one subscriber for every 0.01% every subscriber is 0.1% or 0.1% of views. Okay, so to be able to grow this channel, it would help me massively to have a bigger subscriber base. With a bigger subscriber base, a bigger channel, the community grows, we can put out more and better content. I'm starting to look at bringing team in to help me grow this channel, to put more stuff out more regularly and help get more content to you. So my only request is please hit that subscribe button, hit the like button to help us grow this community, get more powerful content to help you take control of your future. So go ahead, please press subscribe now, click the like button. It's the only thing I'll ever ask you on this channel. In return, I'll continue to do these live streams and work tirelessly to help you do that. So that's my request for you. Okay, cool. So let's see where we are. The housing activity, there's not a huge amount new here. We kind of talked about it quite a lot last week with Nationwide. The big thing here, again, is I just want to re-emphasize, is the lending figures, the mortgage approvals. Year on year, the August figure was 37.3% below August 2022. But if you remember when we talked about it on the last live stream, it actually was at 20 to 30% below the 2019 trailing average. So everything is freezing up, okay? We're in a position, and just to re-emphasize my hypothesis on this, is we're not in a case at the moment that people have run out of money. So we haven't seen mass unemployment. We're not seeing mass unemployment. There's still liquidity in the system. So because house prices are correcting, it means people who don't need to move won't move. So that's constraining stock. Less stock coming on is actually cushioning the house price correction due to supply and demand. This could change very quickly if we get to a tipping point where more people are running out of liquidity, cannot afford their mortgages because the mortgage, or just affordability in general is starting to weigh more. And I'm looking forward to the next data set of savings outflow in the UK, because we saw in the last quarter quite a massive spike of UK savings account outflow now after sort of stockpiling for the last few years during quantitative easing and all the free money sloshing around. A lot of it's now coming out. So we're in that race of people's liquidity versus cost. So the whole market is still pretty much seized up. Now, this is the last one. Second thing, this is the last one I want to talk about the Halifax. Just to go back to here. Pace of monthly decline slows. That's the headline of this report. Let's just crunch these numbers. So this is now the data for the last 12 months on a month-by-month basis and an annual change. If you look at, I've put it here, H1 and H2, so half one, half two. I know it's not calendar year, it's just the trailing 12 months. If you remember it was about this time last year, so you can see it here, these 2 months here. Oh, sorry, I've kind of gone over that. This was mini budget time, so that's November, December. So this is kind of what happened post mini budget last year. We saw that big correction on the Halifax in terms of house price. Now it didn't correlate with the nationwide. The nationwide was a shallower, longer, more drawn out. Whereas in the Halifax we had this big dip down following mini budget, and then we had a much bigger bounce in the spring. But even with those 2 months, we had a minus 2.4% and a minus 1.3% change. If we look at the first 6 months of the last year, we're at minus 1.7 when we tally all those up. I know it's not quite as linear as that. When we look at the last 6 months, okay, so what's that? That's effectively April, May, June, July, August, September, we're minus 3.3%. So even with that skew and little spike down of house prices, we are twice the decline in the last 6 months compared to the first 6 months of the trailing 12 months. So for me, that is showing that we are actually accelerating. Okay, and when we see those 2 months drop out of the data, okay, that's going to effectively, if you see here, we've now got, what's that? January, February, March, 0.2, 1.2, 0.8. That's a 2.2% up. Again, I know it's not as linear as that because figures on figures, but just bear with me in terms of a very crude statistical analysis here. When that Q1, okay, when this Q1 2023 falls out, so when we go into Q2 2024, okay, this data is going to be falling out, and we're probably going to see, I would imagine, depending on what's going on a month-by-month basis over the next 6 months, that year-on-year to be starting to add up quite a lot. Okay, so when that little bounce comes out, so if we just look at that on the actual graph, okay, if I just take, oh no, it's going to take all of them off. Don't worry about it too much. When effectively this bit here falls out of the data and we're starting our year on year from there, if we continue to go down, okay, that year on year is starting to add up quite a lot. And don't forget, year on year, sorry, let me go back into that. Year on year is not peak to trough. If it's going to take us 3 years, 4 years to get peak to trough, the year on year becomes vaguely irrelevant. It's the peak to trough figure that we really care about. Okay, lovely. That is what I want to talk about on Halifax. Just to re-emphasize, I did the figures or looked at the nationwide real-term house prices, so inflation-adjusted house prices. We just had Q3 data come out. You can see how far below the red trend line we are with real-term house prices, which means every month right now, house prices are devaluing on a real-time basis, right? So that equity in your property is devaluing when you account for inflation. And we're starting to look very cheap here, right? If you chart this kind of, I will chart it more accurately at another time. But if we kind of go vague chart there, I know I've put that slightly too low. We're not far off the trough we had post financial crisis. And again, just to reemphasize here, look how long this takes, right? This is when we went into financial crisis, just before financial crisis. That is sort of 2007 to 2013, pretty much a six year period in terms of real time house prices. When we go into a correction, crash, whatever you want to call it, will take longer than nominal house prices, peak to trough. Okay, we can see it again if we go here to here. We're effectively 89 to 95, 96. Again, 7 years. So peak to trough, 7 years here. Peak to trough, 7 years here. It's going to be interesting to see what happens here, actually. If we're going peak to trough 7 years, then we're going into what, 2027, 28, probably 28 until we hit real time. But we're not far off in terms of inflation adjusted house prices where we were back in 2002. So house prices are looking quite cheap from a real term perspective right now, and that continues to adjust. And if you look peak to trough in the current cycle, okay, we are currently 15% down, which is where the headline and the sort of thumbnail for this video came out with. Right now, we are 15% down peak to trough in terms of real term house prices, not nominal, inflation adjusted, which for me is fairly significant already. I've always said I'm probably going to expect that sort of coming up to, I would say, 30% peak to trough inflation adjusted house prices. I've always said we're going to be much higher in terms of inflation adjusted versus nominal. Nominal is being balanced and softened by the wage growth, by inflation. It's kind of flattering, if you like, the nominal house prices, which is why people say that they're resilient. Well, they're not resilient. In terms of their actual value, they're coming down very quickly. I think that's something that's super important that I want to say. I'm just going to go through some questions now, team, before we talk about Metro and the banking system. So let me just come off here. Let me just put my speckies on and see what we've got in terms of got any questions or comments. We got Matt. Hey, how you doing, Matt? Good to have you on. Here we got, hey, we can hear Alan here. Fantastic. Stafford, these figures translate similarly to commercial property prices. Good question, Stafford. So commercial property prices have already capitulated. They capitulated last year. H2 2022 saw a circa 30% drop in real, not in real, disregard that, in nominal prices. Okay. So back end of 2020. Now, just to caveat that, again, it had a massive spike post-COVID in terms of value for commercial property. Back half of last year capitulated. I think it's actually closer to 40%. Reason being, because commercial property is valued not on bricks and mortar, but on yield-based valuations. And there's an inverse relationship with interest rates, yields and values. So because the interest rates are going up, investors need higher yields. So, if you can stick your money in the bank at 5% interest rate, why would you take 5% in a property which has got more faff, more risk, maintenance, all that sort of stuff? So with interest rates going up, the yields on property go up as well. Higher yield means you have to be able to buy it cheaper for the same rent. Let's assume rent roll stays the same. You have to be able to buy it cheaper to get that high yield. So effectively, with yields going up, prices come down, asset prices come down. And that's an important concept in the commercial world, which is why commercial property significantly devalued last year, and why I still believe that commercial property right now is the very best opportunity for value arbitrage if you're an investor yourself to buy commercial, use permitted development to get it changed into residential and get an immediate uplift on a price per square foot basis by arbitraging that value. So yeah, good question, Stafford. Stafford's reckon base rate to rise next time, 0.25%. I think I'm probably in agreement with you. We'll wait and see the CPI figures. Matt, I know we speak about this regularly, Matt. Agree, it hasn't peaked. You still reckon 5.75 to 6. That's going to be interesting if we get up to there. Stay there for a year or so. Stafford again saying house prices look cheap versus inflation. Yeah, agreed. And K-Hart still not sure how people are buying in London. So there is still liquidity in the system. I think that's worth saying. Bank of Mum and Dad is not exhausted yet. Liquidity, don't forget, whenever we look at statistics, we're looking at overall statistics. We're looking at UK-wide statistics. There'll be demographics, especially in London, city, who are still getting huge pay packets, bonuses, all of that sort of stuff, and still want to buy regardless. They don't actually care too much about house prices. You've also got a lot of foreign investment coming in, Middle East, Far East, that goes into London because they want to park it in prime real estate. There we go. We'll continue. Let's have a talk about Metro Bank. So, blimey, it's almost four months ago now that we were talking about Silicon Valley Bank going under and the potential shockwaves that it was sending through. And then pretty soon after Silicon Valley went, don't forget Credit Suisse went, and that caused some real shockwaves. And I remember putting a video out about, are we at the start of another financial crisis? And we kind of came to the conclusion at that point that, after Credit Suisse went, everything sort of stabilized, settled down again, but we weren't going to be surprised if something else happened. Well, here we go. We got Metro Bank in trouble at the moment. Interestingly, this is taken this morning. Don't be surprised if there's another run on a UK bank, and you've got a nice picture of Northern Rock. So people go, oh, Northern Rock, didn't know they exist anymore. They don't. It's just a picture from when we had the last run on UK banks. But Metro Bank is looking to raise a lot of finance right now to bolster its basically capitalization. There are various capitalization metrics they have to hit through FCA legislation. Don't forget, after the last financial crisis, all this was massively tightened up. So Metro Bank is seriously struggling at the moment. However, let's not get too carried away with Metro Bank getting in trouble. Whether it gets bailed out or not, or collapses or not, it's not like this is something that's been triggered recently. If we look at the Metro Bank share price, and look, the reason I talk about stuff like this, I think it's important to understand contextually what's happening, because you can go into the news, have a look at, we've got we've got a financial institution about to go under, and go, it's a systemic issue that's going to drag the whole UK banking system down. And I'm not saying that's not the case. I'm not saying there's not systemic issues. But after 2008, there are so many more safeguards put in place. It should be more difficult for something like this to happen. And there is a big difference between UK banking system and American banking system. In America, you've got a lot more sort of smaller regional banks. They will be more exposed. So when you look at Silicon Valley Bank, okay, they were exposed to a lot of sort of tech companies were banking with them, a lot of deposits from tech companies. Of course, last year was terrible for tech world. So a lot of those businesses were taking their deposits out and effectively creating a run on deposits, which meant that Silicon Valley Bank had to liquidate some of its investments to keep their capitalization ratios correct on their balance sheet. So again, talking about yields and asset prices, if you've got a bond, right, and interest rates have gone up, yields have gone up, the bond value is going to go down. You're selling bonds at a loss or losing lots of money, and it makes people very jittery. They start doing a run on the banks, and it starts to go, out of business and collapse eventually. So that's what happened in America. Now, is that going to happen in the UK? Metro Bank's been in trouble for a while. This is the share price chart for Metro Bank. So I know the headlines talk about like 30% drop this week, stuff like that. You can see, 2018, Metro Bank peaked at a significant share price, and it's been in trouble since sort of end of 2018, beginning of 2019. This is not a sudden case of a well-established, profitable bank with a sustained high share price suddenly getting into trouble. This has been having issues for a while. Obviously now compounded by the global financial situation. It's interesting, I was reading into some of this morning. They've been asking regulators to get some clearances. They haven't got it. That means they have to recapitalize more. They've also got some bonds that they need to effectively refinance coming into next year. Now that's an issue, because again, you can't sell the bond at a depressed price, because it would be, you need to get the capital from somewhere to basically pay that off and get it back up to what you owe on it. So if you're going to refinance it, it's going to be on a much higher rate to refinance. It's going to cost them more to carry that, and that's going to sort of eat into their profit margins. But what I'm trying to say here is this is not a one-off sudden bank going into trouble. It's been having issues for a while. I'm not going to go into all of those right now. When I was looking at that, I started to do some research this morning into the state of the UK banking system, just to get an idea of where we are. Because, of course, this could vary very quickly if we do see other banks start to go down, and we do see mortgage books getting sold off, all that sort of stuff. That can clearly impact lending, can cause credit crunch. Credit crunch will tighten that property correction very quickly. So we need to keep an eye on it, because if it does happen, that will have a material impact on the UK property market. But Bank of England last put out a financial stability report in July 2023, so about a quarter old now. And just to sort of go to the highlights, there's three main sectors they look at. They look at household and business finance, they look at bank resilience, and they look at non-bank finance. Now, I'm going to do probably a standalone video on this report just to talk through it. At the moment, they're very happy with bank resilience. I'll show you a couple of graphs in a bit. Now, whether this is fudged or not is, you can read it. I've linked to it in the description to this stability report for you to have a look at. Bank of England are pretty confident that bank resilience is good right now. They are talking about that household and business finances are under pressure. And clearly, if we are looking at housing market, household finances under pressure is going to impact into house prices over the coming months and years. The thing they are concerned about is non-bank finance. Sorry, I put a tick there. I shouldn't put a tick there. That should be a big cross. And actually, that should probably be in red. They're concerned about non-bank finance. So if you just read the statement here, non-bank financial institutions continue to need more resilience. We are working internationally to achieve this. So that's not looking too hot at the moment. They also talk about the let's just come off red because red is clearly bad. Let's go yellow. Current risk, global economic outlook is highly uncertain and risk environment is challenging. So, when you read through those language patterns, there are concerns kind of systemically in what's going on right now. But if we just go to some of these graphs, I wanted to, they have a non-technical overview to help people like me read it and be able to understand what they're talking about. But they stress tested the banking system. So don't forget, this is it says major UK banks, say not all UK banks. So I don't know whether Metro comes under that, but major UK banks are resilient. They did a large stress test, which showed that, and I wonder if we've got here. Here we go. They stress tested unemployment rate to 8.5%, inflation at 17%, and house prices by falling by 31%. Okay, so that's quite a major stress test. And with that major stress test, it brought back, this is the capital ratio on a bank's balance sheet. Let's not get too technical here. Let's just say the lower this is, the worse it is for the banks. So stress testing now, okay, came down to there, and this is the hurdle rate that things start breaking, basically. So they're saying banks are pretty resilient based on all the extra layers that were put in after 2008. So they're not too concerned about banks or major banks. Let's have a look at households. This is an interesting couple of things we found on households. This chart here shows mortgage payments, the increase in mortgage payments between by the end of 23 and the end of 26. So this blue is the increase in mortgage payments by the end of this year. So we're coming to the end of this year. This is mortgage payments that are going to increase by up to £200 a month, 200 to 500 and 500 plus. So what this is saying, by the end of this year, 2 million people's mortgage payments will be up by up to £200 a month. We've actually got, that's probably about 300,000 people's mortgage payments will be up by £500 a month. Now, by the end of 2026, look, team, we are in 2023. They're talking about another 3 years of this. We're now projecting this out for 3 years, which again is another indication to me that these interest rates are going to be high and persistent for a long time now, and this will affect long-term the housing market. Okay, we're going to have almost 4 million mortgages up by £200 a month. We're going to have almost 1 million mortgages up by £500 a month. That's £500 a month. There's a significant increase in mortgage interest payments alone for households. Now, obviously, this is going to be with higher value properties, higher income demographics, but £500 for 1 million is a huge amount. So, if you look at that, we got almost 4 you got 5.756, you've got almost 7 million households which are going to see those mortgage payments increase over the next 3 years. 7 million, that's significant. Okay. Now we've got another graph here, which actually I zoomed in on because I think this was more interesting to zoom in on. They're offsetting this discussion by saying, regardless of that, and although the proportion of income that UK households collectively spend on mortgage payments is expected to rise, they're caveating it should remain below previous peaks. Okay, so here we are now, right? And it's saying by the end of 2026, we're going to get to, basically it's going to go up from, 6% to 8%. Now, 6% to 8% doesn't sound like a lot, but that's because this is talking about all UK households. Now, don't forget, I think it's about a third of UK households have mortgages. So 2/3 don't have mortgages, right? So you're taking that third of the UK demographic and spreading it across everyone. But they're saying we don't expect it to peak more than here and more than here, right? But these peaks here and here are at the top of house price booms, right? So these mortgage payments are very much going up because house prices are going up. So people are taking bigger mortgages and therefore they have more debt to service. So you can see what happened at the end of both these peaks. It went down because the housing market crashed in both these. So this is your crash end of the 80s into the 90s, right? This is your financial crash of 2008. Right now, we are going up, but the house prices are coming down. So that is, for me, that's a completely different situation. And, if the net effect of this going up means people can't afford stuff and therefore you have a correction, well, it's going up now and we're having a correction already. So when we start peaking over, does that mean the correction accelerates when people literally cannot afford those mortgages anymore? And the other thing that's not being talked about with this is purely debt service ratio for mortgages. We are still in a cost of living crisis. We are still seeing utilities are going to be high. I think people still seem to think. I was speaking to a friend yesterday. It's like, oh, it's all fine this winter because utility prices have come back down again. No, that's kind of not really true. So, because of where the government put their price cap or guarantee or whatever, energy price guarantee, whatever it was called last winter, put that average house about, was it £2,500 a year for an average home, and then they gave basically £500 to everybody over a period of 6 months to offset that. So the average household is netting or spending £2,000 a year on their utilities last winter. This winter, the government guarantee doesn't factor anymore because the price cap is below that. But the price cap is just about £2,000. It's actually just below 2,000. It's about 1,900, I think, as we go into the final quarter of this year. So when you look at it on an average basis, it's pretty much exactly the same that you're going to be spending on an average basis. Now, of course, if you've got a much bigger house, then you're going to benefit more because energy prices have actually, come down. And if you've got a smaller house, it's not going to be as big an issue. But we haven't just suddenly come to the end of energy costs being high. I've just refixed. We've got a large HMO in my portfolio. I fixed it 2 years ago. I think on the electricity, it was 20p a kilowatt hour. We fixed that. I just had to refix again because we're coming to the end of that and refixing at, I think it's 32p a kilowatt hour for electricity. So it's still going up 50%. So our utilities for this sort of HMO went up I think it pretty much doubled when I fixed it 2 years ago. It went from, I think it was like 11p a kilowatt hour, something like that, to 20p a kilowatt hour, almost doubled. And now it's going up another 50%. So we're certainly not at the end of this energy crisis, cost of living crisis. There's still a lot of fragility in the system. Okay, let's just finish this off, team. So I know we've been rabbiting on for a while. The third part of the report looked at market-based finance. And I'm not going to go into this or read it because it's got lots of very large words which are designed for most people to go, that's too difficult to try and work out what it actually means. Basically saying the Bank of England, so people that lend or sort of borrow or that are not banks, they're a concern systemically from the Bank of England. And interestingly, this was a letter that went out last Friday that after identifying a lot of this sort of stuff, the Bank of England issued recommendations for financial institutions to tighten up on various aspects, which they haven't done. And the bank actually sent a open letter to them on Friday saying, look, we've told you to do this. You've not done it. You're not heeding what we're saying. You need to put more safeguards and processes in place to basically, watch out. So you can see this Bank of England down here. Bank of England wrote to lenders on Friday to urge them not to underestimate the risk of loan defaults as higher inflation, increased interest rates hit more vulnerable borrowers. Now, this is households. This is also businesses. I started to go down a rabbit hole of looking at business insolvencies over the last quarter. It's gone up hugely. We're going to do this on another video. But let's just say there's some systemic issues in the financial system that clearly is a concern to the bank. And as inflation stays high for longer and interest rates stay high for longer, everything's creaking a little bit. We'll see how this feeds in to the property market. There we go, team. That is my overview of Halifax HPI for September 2023 and a sort of little overview of the banking system, financial system. Still not seeing, from my point of view, any leading indicators that are showing any reversal in trends. If anything, all the leading indicators are still showing an acceleration of things in the wrong direction for most people, unless you're sitting there, wanting a massive housing crash to happen, which some people do. I know that, and still maintain my narrative. We're not going to see some big crash. It's going to be a slow, long, drawn-out process. Probably prices declining way into next year, if not into 2025. I would imagine, looking at this data. Cool. Any questions on that, team? I'll pass it over to you. Give me a thumbs up if that had some interest of what we're looking into. if that helps you understand anything that's going on at the moment. I keep meaning to create basically almost like a target dashboard for all of the lagging and leading indicators that we talk about on these live streams, so we can sort of on a monthly basis review it on a color-coded system, green to red. Because I think I always want to clarify that I'm not here beating the drum saying I want everything to implode. Those of you who know me know I'm a property investor, I'm a business owner, and I don't want the whole system to destroy itself. That'd be fairly bad. However, it is important to understand what's going on, because in a correcting market, there will be more opportunity, depending on what your models are. So understanding that and being able to leverage that opportunity in an ethical way, I think, is really important as an investor or an active business owner, whatever it is you do. So I'll pass over to you guys. I'll hang around for 5 minutes. If you've got any questions you want to ask or any comments on that. Christopher says, great video. Thank you very much, Chris. I very much appreciate that. Always appreciate the feedback from everybody. Next week, do you know what? I haven't actually seen what date the next CPI print. I don't think it's going to be next week, is it? I think it's going to be the week after next. So we've had quite a lot of what we tend to see in these in the months. At the beginning of the month, we're loaded with property data. We get to the middle to the end of the month, and we're loaded with more economic data. So next week might be a little bit of a quieter week in terms of news. We'll see what I'm going to look more into that financial stability report and see if there's anything interesting we can pick out and look at that. But I thought it was quite telling, just from a snapshot there, the debt to service ratio for households rising into 2026, and actually it still hadn't peaked. It was starting to top out, but it hadn't peaked in 2026. So my thinking is this, as I've always said, it's going to take longer and be more drawn out than anybody thinks. If anybody thinks we're just going to suddenly crash and then bounce back up, I can't see it. If anybody thinks we're going to bottom now and then start rising in 2024, I can't see it. I still think we'll be real-time price reduction in housing for a good few years, potentially another 5 years from here, right? I wouldn't be surprised if real-term house prices are still in decline in 5 years' time, unless inflation massively undershoots. Okay, if we go too hard on the interest rate, Bank of England interest rate, inflation massively undershoots, and then we can see those interest rates being coming back more quickly. But I don't see that happening in 2024. Even on the government's, the ONS's own projections, we're hitting targets probably into 2025. And maybe an undershoot, but I can't see it happening that quickly. So still, my position remains longer, more drawn out, shallower but longer. By the way, shallower and longer does not mean it's not going to be deeper peak to trough. It's just going to take longer to get to the trough. That's my thoughts. Hayes, great analysis. No worries at all, Hayes. Hope that was useful for you. If there's any more, let me know. Otherwise, it must be almost lunchtime. And it is Friday, so I hope everybody has a fantastic weekend, and I look forward to seeing you next week on whatever data we want to chat about next week. So I'll leave you to it, team. Have a great weekend, and I'll see you next week.